In July 2024, the Labour Party secured a landslide victory, entering government with a massive mandate and a public expectation for immediate reform. That support eroded within months. Controversial policies, like the removal of winter fuel payments for pensioners, triggered a backlash that compared the current crisis to the infamous Winter of Discontent. By summer 2026, Keir Starmer resigned, and Andy Burnham was installed as the new Prime Minister. Burnham inherited a state in crisis. While working-class incomes remain stagnant, the government desperately needs revenue to rescue the NHS and increase defense spending against international threats. The administration faces an immediate challenge. They must find billions of pounds without further taxing the working-class voters who form their political base. Former leader Lord Kinnock has stepped back into the spotlight, attempting to set the agenda for the government's upcoming budget. Kinnock is calling for a 2% wealth tax on the top 1% of the population and aligning capital gains tax with the higher rates charged on income. The pressure is intense. Health Minister Stephen Kinnock, Neil's son, now finds himself defending the government against his own father's proposals during live morning news interviews. This raises a critical question for the new Prime Minister. Is taxing the ultra-wealthy the solution to Labour's funding crisis, or is it an economic trap? These proposals have become the defining ideological battle line for the Chancellor's October budget. The plan, supported by groups like Tax Justice UK, specifically targets individual assets worth more than £10 million. Proponents argue that the government's biggest failure is a lack of narrative. They believe the state needs a policy that clearly defines who it is fighting for. This aligns with growing public anger. Working-class wages have stalled, while the asset values of the wealthiest families continue to rise sharply. Lord Kinnock admits that the wealth tax won't actually raise enough revenue to pay all the government's bills. Instead, he views the tax as a gesture of equity, a way to satisfy a public frustrated by gutted services and the feeling that the interests at the top always emerge unscathed. In this view, a wealth tax is a tool for political survival, designed to build a story of fairness rather than just balancing the books. However, independent analysts and Treasury officials focus on a different set of numbers: behavioral economics and revenue maximization. This is the Laffer curve. As tax rates rise, revenue increases, up to a certain point. Past that inflection point, and revenue drops. If capital gains tax is too high, investors hold their assets. A projected £12 billion gain could actually become a £7 billion shortfall. There is also the threat of capital flight. Wealth is highly mobile, and the ultra-wealthy can choose to leave the country to avoid new levies. Nigel Farage has argued that aggressive taxation is already fueling an exodus of high taxpayers, making the UK an unattractive place for international investment. But the data suggests a harsh trade-off. Taxing a mobile 1% can trigger shifts that bankrupt the services the government is trying to fund. This leaves Chancellor Rachel Reeves in a difficult position as she prepares the first budget of the Burnham era. She is squeezed between the ideological demand for a narrative of fairness and the math of a globalized economy that rewards capital mobility. The details of this October budget establish the economic philosophy of the Burnham administration. Ultimately, the government must choose between sending a political message of equity and optimizing for the actual revenue needed to keep the country running. To track how the Chancellor navigates this crisis and to read the latest analysis of the October budget, visit londoner.news.